So imagine hitting enter to submit your company's, pristine financial records to the government. Like you're expecting a completely clean bill of health.
All right, because everything looks fine on your end.
Exactly. Your book's balance, the month-end close was flawless. The CFO already signed off on it. You hit the button, and instead your screen just explodes with thousands, maybe even tens of thousands of structural validation errors. Like everything is just flashing red.
Yeah, that is a truly terrifying moment for a finance team, mainly because it just shatters um, a very comfortable illusion.
Oh, for sure.
Because the tool that's delivering this wake-up call, it really does not care about your clean month-end close. It cares about the underlying architecture you used to actually get there.
Welcome to the deep dive. Today, we are looking at what might be, honestly, the most brutally honest mirror a corporate finance department will ever look into. We're talking about SAF-T, the standard audit file for tax.
It's a massive topic right now.
It really is. Now, we are pulling from two incredible pieces of analysis today. There's an article titled SAF-T Financial Architecture X-Ray and a companion piece called SAF-T Tells Truth About Financial Data.
Both really excellent resources.
Yeah, and our mission here is to explore why producing this specific digital tax file is the ultimate unvarnished assessment of your organization's data architecture and, why you need to care about this, especially if your company operates across borders.
Absolutely.
Okay, let's unpack this because the disconnect here is just wild to me. I mean, a company can have perfectly clean books for years, right? Sail through traditional financial audits without a single material adjustment.
Oh, yeah. Happens all the time.
And then they just utterly fail a SAF-T validation on day one. How does that even happen?
What's fascinating here is that SAF-T doesn't actually create a single one of those data quality problems. I mean, it merely reveals them.
It just shows what's already there.
Exactly. Every single validation error lighting up that dashboard represents a structural flaw that was, well, it was always there. It was just hidden beneath the surface of partial reports, aggregated data, and, compensating manual controls.
So traditional compliance is basically just letting us hide our mess.
Pretty much.
Like when you think about a standard VAT return, you're really just looking at a defined slice, right? It's a summary of transactions over a specific period, just grouped by tax rate.
Right, a summary, not the raw data.
So if I have, say, $1 million in sales subject to a 20% tax, as long as I remit $200,000, the authority is generally satisfied. I mean, they aren't looking at the individual rows.
No, they aren't looking at the rows, and they certainly aren't looking at the metadata attached to those rows.
Right.
Traditional methods tolerate an incredibly imperfect underlying data architecture because they just don't look at the entire ecosystem.
Makes sense.
Like e-invoicing, for example. It only looks at a single billing document in total isolation. But SAF-T is categorically different. It requires a complete, structured, internally consistent representation of the entire general ledger.
Wow. So it's the whole universe mapped out. Every account, every period, every transaction, plus all the master data contextualizing it.
Every single piece of it, yeah.
It sounds like traditional reporting is like taking a nicely framed photograph of the front of a house. It looks great. The paint is fresh. The lawn is mowed. It looks perfect for the brochure.
Sure, from the outside.
But SAF-T is more like a structural engineer's X-ray. Like it shows that the foundation is actually cracked. The plumbing doesn't even connect to the main water line. And half the rooms don't exist on the official blueprint.
That is a perfect analogy because that structural X-ray exposes the raw truth at a level of precision that no internal process has previously required. I mean, if a room is missing on the blueprint, the X-ray shows it immediately.
There's just nowhere to hide.
There is literally nowhere to hide. There is no aggregation to hide behind anymore.
Okay, let's walk through the actual life cycle of a transaction to really see how this X-ray, rips a company's data architecture apart. Because it's one thing to just say data quality is bad, and it's another to see how a single invoice triggers a chain reaction of failures.
Oh, it really is a chain reaction.
So let's start at the very beginning of the life cycle. Onboarding a vendor or a customer. What breaks here?
So this is where we hit our first massive failure point, which is master data completeness.
Okay.
Think about a clerk setting up a new domestic customer in the ERP. They're in a rush, right? The legacy configuration from, say, 2005 allows them to just bypass the VAT registration number field.
Or like the registered address field or something.
Exactly. Because for domestic sales, the system didn't strictly need it to calculate the invoice total.
Right, so skipping that screen just becomes the cultural norm for the department. It's just how they do things.
Exactly. It becomes completely embedded behavior.
Yeah.
But under the SAF-T schema, those optional fields are retroactively mandatory.
Oh.
Yeah. The tax authority demands to know exactly who you are transacting with. You cannot submit a compliant file if the master data fields are blank.
And I imagine it's not just a few records we're talking about here.
No, it's often tens of thousands of business partners that have just been sitting in the CRM with incomplete profiles for a decade.
Man, so the foundation is already cracked before we even process a single sale?
Pretty much.
Okay, let's move to the next step. We've got our incomplete customer, and now we generate an invoice. This introduces another massive headache I noticed in the sources, which is tax code proliferation.
Ah, yes. The graveyard of orphan configuration.
The graveyard, right.
Over the years, companies undergo just countless one-off compliance changes. Maybe there was a temporary VAT reduction during a crisis, or some highly specific local tax rule that only applied for 6 months.
So someone creates a custom tax code in the system, it gets used on maybe 3 invoices, and then they just leave it there floating around forever.
And then, 3 years later, a completely different user accidentally selects that obsolete tax code from a drop-down menu because, let's face it, the naming conventions are usually terrible.
Right, it's called like tax rule B.2 or something unhelpful.
Exactly. Now, traditional reporting might just aggregate that mistake into a broader bucket so nobody really notices, but SAF-T forces you to map every single active tax code to its standardized taxonomy.
Oh boy.
Suddenly you have to explain to the tax authority why you are actively using a code that was officially deprecated 3 years ago.
That is brutal. Okay, so the invoice is generated with a weird tax code, and now the customer actually pays us. So we have a payment clearing document. This brings up the issue of broken document reference chains.
This is a big one.
Right, because a healthy financial system needs an unbroken mathematical chain from the purchase to the payment, right?
It absolutely requires an explicit traceable link.
Right.
Like when the cash actually hits the bank, the clearing document must reference the original invoice number.
Makes total sense in theory.
But human behavior ruins this. A user might not know the invoice number, so they just type miscellaneous in the reference field to force the transaction through.
Or they just leave it blank entirely.
Exactly.
Which means that payment is now just a standalone entry. It's just floating in the void with absolutely no traceable connection to the originating business event.
And SAT schema explicitly looks for those links.
Yeah.
I mean, it is entirely designed to trace the whole economic reality of a transaction.
Wow.
So when those links are severed because a user typed MISC, the file validation just fails. It flags a structural deficiency in your entire audit trail.
So we've got bad master data, zombie tax codes, and broken reference chains, and now we hit the end of the month. We have to close the books and consolidate. And this is where the messy chart of accounts comes back to bite us.
Oh, charts of accounts grow organically and often incredibly chaotically.
Yeah, I bet.
A company might acquire a competitor and just, bolt their 3 ledgers onto the existing system.
Right. Or a project manager demands a highly specific internal account to track some niche expense, and they name it something completely non-standard.
Exactly.
Right. They build it for internal management reporting, not for statutory compliance.
But SAT does not care about your internal project tracking. It has a very rigid, standardized taxonomy.
So if your quirky custom-named account doesn't map perfectly to, like, an asset, liability, equity, revenue, or expense category in the exact way the government demands,
the whole file crashes.
just crash it.
Yeah, that mapping process is brutal because you often realize your internal accounts are actually blending different types of economic activity.
Oh, I see.
You can't map one internal account to 2 different statutory categories without essentially rebuilding your entire ledger logic.
Which brings us to the final, and honestly, I think the most terrifying stage of this life cycle, period boundary inconsistencies.
Terrifying is the right word.
From what I gathered, this isn't just a missing text field. This is when the opening and closing balances mechanically shatter, and the math literally just stops working.
Yeah, and it requires actual forensic accounting to unravel. This usually happens when someone makes a retroactive adjustment.
Okay, walk me through that.
Let's say it's April, and a controller realizes an accrual they made back in January
Right.
was incorrect. So they force a topside journal entry to fix the general ledger.
Okay.
But they don't push that correction all the way down into the subledger.
Ah. So the top-level financial statement looks totally fine, but the underlying granular data is just completely out of sync.
Exactly. So when SFT extracts that data, it pulls the granular transactional rows and attempts to rebuild the period balances from the ground up.
Oh, no.
Right. If you've been making topside adjustments, the SFT file will objectively show that your closing balance for January does not match your opening balance for February.
That is an absolute nightmare. It means your own system is essentially testifying against you, just proving that your ledgers don't reconcile.
And you have a matter of weeks to explain it to a tax authority.
Here's where it gets really interesting. Because the deadline is looming, right? The validation just failed spectacularly, and the organization is staring at this massive dilemma. They have to choose how to actually respond.
It's a huge fork in the road.
Now, if I put on my stressed out CTO hat, my first instinct is to tell the IT team to handle it at the extraction layer. Like, if the customer is missing a VADA or an account is mapped wrong, why not just build a transformation rule in the reporting tool?
Write a script.
Exactly. Write a script that says, if VAT is missing, insert a default placeholder. Just force it through so we can pass the validation schema for this cycle.
That is absolutely the most common immediate reaction, and it is a trap.
Really?
You are attempting to fix a data governance problem with an IT extraction tool.
It sounds like trying to translate a book written in gibberish by just adding an infinite number of footnotes. Like, you aren't actually fixing the original text, you're just creating this bloated, unsustainable translation key that gets heavier and more confusing every single year.
That is a brilliant way to conceptualize the technical debt you are taking on there. Because if you build workarounds in the extraction layer, you are taking imperfect source data and contorting it to just look compliant.
Right.
But next year, you will still have all those exact same underlying bad habits, plus whatever new messy data was generated over the last 12 months.
Oh, man.
So the extraction layer just grows incredibly complex. It gets bloated with exceptions, hard-coded rules, temporary fixes.
So producing this SAF-T file just becomes this annual high-stakes emergency where everyone crosses their fingers and prays the script doesn't break. You're permanently treating the symptom, not the actual disease.
Moreover, if you inject a placeholder VATID just to pass a technical validation, you are formally submitting fabricated data to a government tax authority.
Oh, wow. I didn't even think of that.
The legal and financial risks associated with that are staggering. You cannot fix a missing counterparty detail with code. You have to physically contact that supplier, verify their information against official tax registers, and actually update your source system.
So the alternative to the Band-Aid is actually doing the unglamorous architectural work, like fixing the source.
It is the only sustainable path. I mean, you initiate a chart of accounts rationalization project to standardize your ledgers.
Okay.
You change the ERP configuration, hard-coding the rules so users physically cannot process a payment without linking it to an invoice reference.
Right, taking the human error out of it.
And you launch a master data remediation program to scrub the CRM. It requires a really significant upfront investment and cross-departmental coordination between tax, IT, and finance.
But the payoff is that generating this SAF-T file just becomes a push of a button operational routine, right? It's just a regular Tuesday rather than a whole fire drill.
Exactly. And if we connect this to the bigger picture, the payoff is actually monumental, and it extends way beyond tax compliance.
How so?
Organizations that take the hard road and fix the source accidentally build a canonical data model.
Oh, let me jump in here because I really love this concept from the sources. A canonical data model basically means you are creating a universal language for the entire company's data, right?
Yes.
You're doing all this painful cleanup just to get the government off your back, but suddenly the rest of the business reaps all these rewards.
Exactly.
Your AI tools and real-time analytics finally have clean, structured data to chew on instead of just hallucinating insights based on garbage inputs.
The downstream effects are completely transformative. I mean, the CFO has probably been begging for this level of data hygiene for years.
I'm sure they have.
When your counterparty data is finally reliable, your credit management and risk assessment improve overnight. When your reference chains are unbroken, you can deploy continuous automated reconciliation.
So you no longer have teams of human accountants hunting down mismatched invoices at the end of the month.
Exactly. The system simply matches them mathematically.
So SAF-T is essentially a Trojan horse. It's this external regulatory mandate that forces the internal investment companies desperately needed to make anyway. It tricks them into building the financial intelligence architecture they should have had all along.
It acts as the ultimate forcing function. Without the threat of regulatory penalties, it is just far too easy for corporate leadership to push data cleanup to the next quarter or the next fiscal year.
Always putting it off.
Right. SFT removed the option to procrastinate.
Knowing that this massive architectural upgrade is the ultimate goal, it seems insane to wait until the government issues a firm deadline. I mean, the smartest players in this space must be running diagnostics way before the inspector even shows up.
The organizations that actually manage this transition successfully take a very proactive diagnostic approach.
Like a trial run.
Exactly. They extract their current messy ERP data and run it against the SAF-T schema well in advance of any mandate. They use the standard as a diagnostic tool to map out their vulnerabilities.
Because if you operate multinationally, doing a group-level data architecture overhaul is just exponentially more efficient than playing regulatory whack-a-mole, trying to patch things jurisdiction by jurisdiction.
Oh, without a doubt.
And we really need to emphasize the global horizon here. This isn't just a niche European rule anymore.
No, not at all. The standard was born at the OECD and pioneered in Portugal, but it is rapidly becoming the global baseline.
Right.
We're seeing adoption in Poland, Romania, Norway, Austria, France, Lithuania. It's fundamentally shaping the European Union's massive VAT in the Digital Age initiative.
Wow.
The specific XML structures might have minor local variations, but the core demand complete classified reference transaction records that is universal.
Which means even if you aren't an accountant or a tax director, you need to care about this. If your company operates globally, the standard is coming for your data.
It really is.
It is the dividing line between managing your regulatory environment with real confidence or just operating in a constant state of high alert anxiety. Your data hygiene is quite literally becoming public record.
And that reality shifts the entire paradigm of financial oversight. Historically, tax authorities relied on random sampling.
Right, like an auditor would arrive, ask for a few specific binders of invoices, and just look for anomalies manually.
Exactly. It was inherently limited. But SAF-T allows them to abandon random sampling entirely.
Because they don't need a sample when they literally have the entire database.
Exactly. They are transitioning to systemic data-driven oversight. They ingest your complete financial record into their own highly sophisticated analytical engines.
Wow, so they have everything.
Everything. They don't have to guess where your risk areas are anymore. They use your own cold, hard data to pinpoint exact anomalies like broken reference chains or suspicious tax code applications.
Right.
They literally identify their audit targets algorithmically.
So what does this all mean? Pulling all these threads together, SAF-T is far more than just some dry, arbitrary compliance hurdle designed to make corporate life miserable.
Right.
It is a mirror that reflects the absolute truth of your financial architecture. It ends the era of comfortable ambiguity, forcing companies to ensure their data is complete, consistent, classified, and traceable from day one.
This raises an important question.
Yeah.
One that really pushes past the immediate stress of implementation.
Yeah.
Regulatory bodies across the globe are currently building the infrastructure to ingest, map, and analyze the unvarnished truth of a company's entire financial history. What happens when they start cross-referencing that granular data with other jurisdictions in real time?
Oh, man.
Right. Well, the concept of a human routine financial audit completely disappear, replaced by an omnipresent automated algorithm that knows your company's financial flaws better than your own CFO does?
That is a chilling, but honestly, entirely plausible future to leave you with. That algorithm won't miss a skipped field or a broken link. Thank you for joining us on this deep dive into the true cost and the surprising hidden value of financial data architecture. Hopefully, this conversation prompts you to look at your own organization's data with a much more critical eye, because that regulatory X-ray machine is getting plugged in, and it's going to show every single crack in the foundation. Until next time, keep digging.